Okay, today oh man, that's a bad mustache. Okay, that's better. So like I said, today we're going to be looking at economic integration, and really all this unit is about, or this little subunit is about, is trying to figure out the difference, or see the difference between trading agreements that are least integrated to the agreements that are more integrated. So again, what we'll see here is there's a few different types, and we'll start with our least integrated, so something that is still very protectionist. The countries that are involved still are protecting their domestic industries quite a lot. And then we'll move down through free trade area all the way to complete economic integration, and that's the most integrated, where basically within the constituents there is completely free trade. And remember that when completely free trade is happening, then the idea is that comparative advantage has been fully maximized. So to start with, let's look at a preferential trade agreement. And I'd like you guys, this is on my OneNote, so go ahead and click on this link and just follow along with what I'm looking at on that page. So now that you're here, you should be looking at this right here, the India-Afghanistan Preferential Trade Agreement. Take a second, put the video on pause, and go ahead and have a look through this real quickly. You don't need to read it in depth, but just try to get an idea of what it's covering. Okay, now that you've had a look at it, what I want you to think about is the language inside of the preferential trading arrangement. So again, here in Article 3, we see that all it's saying is that they can reduce tariffs. No call that they have to or anything like that. So again, this is a very weak agreement, and when you read through it, there's all sorts of ways that a country could still protect itself and its domestic businesses. So this is an example of a bilateral trade agreement, and again, all bilateral means is that it's just between two countries. It's not between 3 or 4 or 5, that would be multilateral. That was just between Afghanistan and India. An example of a multilateral agreement would be the next one down, and that's a free trade area. Now again, it doesn't have to be every free trade area is going to be multilateral. It's just another example. So a free trade area is more integrated than a preferential trading agreement, but it's still not nearly as integrated as the ones that are below it. So with a free trade area, the key is that within the free trade area, so again, NAFTA, CAFTA, those are good examples. There's lots though. Within the free trade area, there aren't any tariffs between the countries for the most part. There might still be a few, but it's very rare. So again, a good moving from Mexico to the US or from the US to Canada, there would be no tariff on that whatsoever. Again, this is really important for Mexico. We talked about this a little bit in class, but Mexico, you know, its #1 trading partner is the United States. I think some 80% of Mexican goods are sold to the United States. So that's going to be a big advantage for them when they don't have to pay any sort of tariff on goods coming into the US. So within this system, there would be lots of competition. That is that, you know, the factors of production that are from that are in Mexico that are the best at making a certain product, for example, textiles, they're going to be the ones that make the product. Whereas a factor of production that is in the U.S. that is has comparative advantage for making something else, say cars, they're going to make the cars. Although the Mexican car industry is growing quite significantly. So again, within this system, we ought to see that comparative advantage is going to work rather well. However, there is still going to be competition between these countries externally. So for example here, Canada has the lowest tariffs. Now that's just an example. I have no idea what kind of tariffs these individual countries may have. But now when Canada and the US are competing against each other to get business from, say, Japan, well, Japanese business is more likely to want to go to Canada because of this lower tariff. So even though there's not protectionism within this, there is still protectionism outside of the free trade area between the three countries that are involved because of the different tariffs. The next one down, a customs union, is the exact same as a free trade area, except they do have a common external tariff. So now they're not competing against each other with countries outside of the customs union either. Good example is Mercosur, which is it's the common market of the South. They call themselves a common market, but they're not actually. They're on the way to becoming a common market, but right now they're still just a customs union. Okay, a common market, best example is the EU. And what that provides for is that factors of production can move around quite easily inside of the country. So, whether it be, your land, obviously you can't move that around very well, but if there's, fertile land or a good place to put a business in Italy, someone from Ireland can freely go start a business there. It's not difficult. So the same goes with labor or capital or anything like that. So this is the real key that sets this apart, because it really allows the best factors of production to go where the most comparative advantage will be. Okay, one stage up from that, so again a bit more integrated, is the EMU, the Economic Monetary Union of the EU. So basically all the countries that use the euro inside of the EU. So this would exclude the UK, I think Denmark, a few others. Basically, countries that don't use the euro. And the key here is that these guys, because they do use the same currency, they're all going to be affected by the same monetary policy. So essentially, it just gives the central banks a lot more clout. Again, if you're the central banker for a small country like Belgium, with not a lot of money supply, your monetary policy might not be very effective. So instead, the monetary policy for the whole country, they could lower interest rates, change the discount rate, that sort of thing that we talked about last unit. Now, one big problem with that is that because they're not fully integrated, they can't conduct any fiscal policy. So, if you've heard about the pigs, that's Portugal, Ireland, Italy, Greece, and Spain. These are the countries of the EU who basically their fiscal policies have gotten out of control. They've had massive deficits, borrowing lots of money, and basically they can borrow lots of money because of the strength of the monetary policy in the EU. So it's kind of like, and sorry, Angelo or anyone else who's from one of these countries, but it's as if they're taking all the benefit of being in the EU, but then they're kind of squandering it. So to get away from that problem, the next step up is complete economic integration. And, there's not a lot of great examples, but the UK at one point was much more, the countries were much more separate than they are now. Likewise, the United States, technically the United States are 50 different states, but of course we don't think of them that way because they are completely integrated. So, where we didn't see fiscal policy in an economic and monetary union, we do see the ability to conduct fiscal policy as well as monetary policy. And that's about it. So in a country like that, or in a place like that, an economy like that, in the United States or the UK, we don't see any sort of problems with the ideas of comparative advantage. We look, or I don't mean we as a U.S. Citizen, but I mean economically, we see that. So in a situation where there is complete economic integration, basically there is no protectionism anymore. The only way a company can do well is by making the best product at the best price. There's no sort of advantage any company will have because their government is taking care of them in one sense or another. Okay? Bottom line, we're looking from least integrated to most integrated, understanding that the closer we are to complete economic integration, the better that comparative advantage is going to work.